don't remember exactly how it works.
Yeah, fair play.
Yeah, I thought there might be a group turning up too, but who knows? All right, let's see if we can catch this. I thought there might be a group turning up too, but who knows? Let's see if we can catch this. I thought there might be a group turning up. That gets muted. You ever do any videos or anything like that?
No, not really.
I'm actually curious. You have a smartphone or something, right?
Yeah.
I'm actually curious. Could you check for me on the stream to see if it's sort of coming out?
Yeah, sure thing.
Now I shall grab the. It occurred to me that I could have actually. I mean, people are back by today, right? Everyone should be back today, but the university wouldn't schedule anything for today, so that's
okay.
so that also was an issue.
Rhinestone Live. Oh, that turns up when you search Rhinestone.
Ooh, that's weird. It's got. They probably have artificial intelligence. So I'm sure if you weren't here in the university and you search Rhinestone Live, you'd see something else.
Yeah. Yeah, it's live.
Okay, so you see
8 people watching.
Yeah, I see the same. And you should probably mute it though, otherwise we'll get an echo. How's the screen looking?
If you tilt it a bit further down, then it'll see more of the board.
But then I need to probably back up a little bit. Okay. And suppose I were to write something on the, but then my head's cut off.
Oh, yeah.
For what it's worth.
Oh, yeah,
not that my head's so important, but it's a bit of a reflection.
Yeah, there you go.
So do you see the word revision here? Is that clear? I mean, obviously the light's not perfect. We're not a studio here.
Yeah, I can see revision.
Okay. All right, let's get started. It looks like there's 15 people now, so that's like a quorum. If anyone's there, welcome, Happy New Year. And can you tell me, is the sound okay? Is the video okay? Is there anything in particular that needs to be adjusted before we get started? You should be able to message in. I don't know if you want to remain anonymous there. We have one person present in the room. If he wants to be famous. Hey,
Efair.
Yeah, you can ask questions on the messaging. And sorry, what's your name again?
Harry.
Harry, if you want to ask questions as well. You can serve as the Vokes, a Latin word for student, whatever that is. Okay, so the plan was to cover the questions that I mentioned on the forum. I have them circled here. So let's start with so there could be anyone here actually from the whole world, but I'd be shocked if there's anyone outside of Exeter University on this stream. All right, we'll start with question 11 from the mock exam. Okay, and I think everyone knows what I'm talking about when I say the mock exam. That's it's up on Dropbox. You know, it's up. The Dropbox link was up. We've been commenting on it. It's linked in the webbook. And the format more or less follows the format of what the exam will be, with the exception given that there's going to be 5 questions in Part B instead of Part 6, as I mentioned. Okay. Start with question 11. Okay, question 11, it says, choose to partial credit will be awarded. By the way, on the exam, it won't say choose to partial credit will be awarded. I don't think I have any choose to questions. On the actual exam, it's going to say choose all that are correct and none that are incorrect. And we've had discussions about the marking scheme for that. Okay. Under standard, so that this was a vestigial from a previous exam, that format. So I should have adjusted it. Okay, this is what the question asks. It says, under standard assumptions, risk-averse individuals will diversify their investments because this has the potential to ... Okay, so maybe choose all that are correct and none that are incorrect. Okay, by standard assumptions, I usually mean classical assumptions, the assumptions we've been embodying for this module throughout, unless I said, by the way, there's some behavioral economists who assume this other thing. Okay, risk averse. Remember how we define risk aversion. There's a few equivalent definitions. One is that a risk averse individual will never accept a fair gamble, never accept a gamble with zero win or zero loss in expectation. They'll never accept a flip of a coin, heads you win a pound, tails you lose a pound. They will always prefer the expected value of a gamble to any gamble. So they dislike any variance. And this, as we model it, this stems from them having a utility of income curve. That was that little u of, I guess we called y income, that was increasing, yes, but at a decreasing rate. Okay. Just to give you some background. Okay, so choose two. Under standard assumptions, risk-averse individuals will diversify their investments because why? Okay, first one says reduce their transaction costs. Okay, what would transaction costs be? Well, you could think about, if I invest in a lot of things, in a conventional sense, transaction cost would be the cost of buying and selling those shares. Diversifying, buying lots of different shares of different things, if anything, would increase your transaction cost rather than just buying a single thing. So that couldn't be why risk-averse individuals will diversify their investments. Okay, but we're not going to worry about transaction costs when we talk about the investment problem. We abstract from that. So A is not correct. B, increase the maximum expected returns they get. That'll be in a different video, Bob. Can it increase the maximum expected returns you get by diversifying? Well, that's not true. There'll be a set of, so let me draw the diagram that we've seen a bit before. And, I just want you to have a sense of this. So we have different investments. Each investment has an expected return and an expected variance. So I can I can say this could represent the variance of of the profit that I'll get, pi for profit. You could just think about this in a casual sense as risk. Some investments will have more risk or more anticipated risk. I expect that it will be something that I could invest in that we might think would be very risky. Maybe a startup company I could invest in, or some penny stock maybe you could see as risky, some risky enterprise. But it might be that you'll expect to get higher return for more risk. And in a different discussion, I discussed what kind of risk will be rewarded by the market. It's the risk that's not correlated to, it's the risk that is correlated to the market risk. But let's leave that aside. Okay, so I have a different bunch of investments with different levels of anticipated risk. I expect some to be more risky. And then this axis we could call return or expected profit. Okay, so each of these assets that I could choose among individually, or I could allocate between, each of these assets will have an individual risk or individual anticipated risk in return. By choosing a bundle of these, it's not that I can get a greater expected return than any of these individual assets, right? I mean, if I have half of something that has an anticipated 10% return and half of something that has an anticipated 20% return, then roughly speaking, my anticipated return would be 15%. Sorry, I was going to give you a point to answer, but that's okay. So it's not that it gives you a higher expected return than, let's say, the investment with the greatest expected return. So B is incorrect. It doesn't increase the maximum expected return you can get. But by diversifying, by buying a little bit of each of these assets, and you can read on what CAPM predicts the optimal diversification will be, capital asset pricing model, something you might want to read up on. I gave some links. Even just reading the Wikipedia article will give you a good sense of it, capital asset pricing model. By mixing all of these assets, you will end up with a composite asset with a certain return and a certain risk, let's say this big blue dot here, and what properties does this have? Well, we're going to draw something called the market line that goes through this big blue dot. Okay, so what investors can do is they can optimally diversify, getting them to this point that's in fact, let me put it here so that it doesn't seem to be illustrating a greater expected return. So let's say it's here, okay? This big blue dot here. Okay, this dot here gets me, oh, sorry, this should still be there. Okay, so gets me to a point that given the level of risk I'm taking, or compared to any individual asset, has a greater return for a given level of risk, or similarly, for a given level of return, has less risk. Okay, but then suppose that this is not the risk return combination I like. Suppose that I actually think I would like to take on a bit more risk to get more return, or less risk to get less return. This is discussed in the textbook. Then what I can do is, instead of putting all my investment in this diversified mix, I can put some of it in this and some of it in this risk-free asset. We used to say treasury bonds, but let's just say putting it in the bank. And that would move me over here along this line, which this line reflects buying and selling the risk, or selling the risk-free asset. Suppose this point was not risky enough for me. Suppose I thought I would be willing to accept greater risk in exchange for greater return. Well, then again, I will diversify my investments. I'll put all of my money in this bundle, but then I'll also even leverage it, borrow money, and invest more of that money in this mix here. So that would allow me to move in this direction. So these are all of the points that you can attain by optimally blending the assets, finding that diversified bundle, and then either borrowing or lending at the risk-free rate.
Surely, borrowing something at a greater risk, though, each time that you add a trade, shouldn't that change the gradient of the line slightly? Or am I...
So this line is, I've bought this optimal portfolio, right, which gives me the sort of the point that's highest along. It's a little bit complicated to explain. I don't want to get into detail, but it gives me the point that's basically, let's say it gives me the greatest return for a given risk. Okay. Okay. So continue. So if I bought a different mix of these, it might put me at a point slightly below this line. But if I buy the optimal mix of these, it puts me at this point here. And then, so continue with your question.
But in most cases in the world, you wouldn't have someone buying a little bit of every possible trade. So, and therefore, when they added a new trade into the mix, surely the line would be changing in its gradient slightly, because it would be adding a different factor to the whole equation. So
I agree with the first part of what you said. And by the way, someone asked a question online, which I'll answer in a second. The first part of what you said is correct. In the real world, people won't buy a little bit of every asset in existence, right? Because of, among other things, the transaction costs that I alluded to a moment ago. But this is an idealized model. Okay. So suppose there's only a certain number of assets and no transaction costs. The second thing you said is, what about the gradient of this line? In other words, the slope. You mean the slope of this line?
Yeah.
That's determined by what the risk-free, if I'm remembering correctly, by what the risk-free rate of is that right? It's determined by. Okay, I've forgotten temporarily what the slope of this line is determined by. I believe it's determined by the risk-free. It's determined by the risk-free return / risk-free rate of interest. But I will check into that again. It's not occurring to me right now. I believe that's what the slope of this line is determined by. So if you're risk averse, by diversifying, you can attain any point on this line if you optimally diversify. If you don't optimally diversify, you will definitely attain a point below this line. Now, if I'm risk averse, I know a point below this line is definitely worse than some point on this line. How do I know that?
Because you're not getting the returns that you could be for that amount of risk.
Exactly. Or equivalently, so let's look at this undiversified point. I'm not getting the returns I could be getting for this amount of risk, or I'm taking on too much risk for this amount of return. So if I value return or value expected return, and I disvalue risk, I find risk something I want to avoid, then this would be suboptimal. So if I'm a risk averse investor, I would always prefer a point on this line to a point within here. So I'd always prefer to diversify. The second question you might ask is, how does diversification reduce risk? We discussed this in lecture with the discussion of the coin flips, and I would suggest looking at that again. But just to give you a brief sort of memory flash, if you remember, if I bet all my money on one coin flip, so I have 10,000 to invest, I bet it all on one coin flip, I either get 0 half the time or 20,000 half the time. So all the probability would be massed here and here. This is half the probability here, half the probability here. On the other hand, if I take 2 coin flips, what is the probability? If I bet 5,000 on 2 coin flips, double or nothing, what is the probability going to look like, if you can remember?
25% on 20,000, 25% on 15,000.
Sorry, 25% 20,000.
Yeah, 25% 20,000, 25% 0.
Yes.
And then 50% 10,000.
50% you end up where you started, 10,000. Okay, let me deal with the questions online. Tuba only for donkeys. Possible to have low risk or high risk return, or is the asset high return because of the risk associated with it? Okay, so I think I'm getting what your question is here. It's a bit shorthand. Is it possible to have low risk and high return? Okay, the second question you might ask is, all right, what determines the return of each individual asset in the market in this model? Okay, and I don't want to go into detail on that now, but I discussed it in lecture, and you can look into the capital asset pricing model in the notes. Basically, assets, assuming everyone's going to be doing this diversification, mixing the assets will be rewarded, assets will be valued higher, the cost of the asset will be greater, meaning it has a lower return, to the extent that it is uncorrelated with the other assets. If it's correlated to the market, then it adds risk to your mix, to your bundle, that you cannot diversify away from. But if it's a coin flip, or if it's even reversely correlated to other assets, then in fact it will reduce your aggregate risk, meaning it should be priced higher, meaning you should expect a lower return. So to some extent, an asset is high return because it has high risk associated with it, but it's only a particular kind of risk that will be rewarded with high return, and that is the risk that cannot be diversified away from. So it's okay if this is, this is a little bit complicated, it's a little bit stretching a little bit further, but I wanted you to have a sense of this model. Let me just go into answering the rest of the question, just making sure we get the right answer. So will it reduce transaction costs? No. Will it increase the maximum expected return? No. Will it reduce the availability? Will it reduce the variability of returns for a given expected return? Yes. You see this, suppose I diversified and then decided to leverage a little bit, and I put myself here or here, whatever, here. You'll see that compared to any of these assets in here, compared to any of these assets in here, i.e. undiversified investments, it for a given expected return, it has less risk. It has, for any other assets with this expected return, compared to any assets with this expected return, the risk is lower. Okay, so C is correct. We collect C. D, provide them with some variety. That's basically a joke answer because investment goods, the idea of the investment is not you're enjoying the investment. The idea is that it produces a return that you can then use for consumption. So D is basically a joke answer. Sorry, I skipped one here. Sorry. Increase the maximum expected return. Sorry. I thought I had fixed this in the thing. I'm sorry. Okay, so in fact, in this question, there's only one correct answer of the answers listed. Okay, I had adjusted it without adjusting the answer guidelines here. If you look at solution guideline, another possible correct answer would be increase the expected value of the returns for a given level of variability. So for a given level of variability, so compare this point reached here. For a given variance, it gives greater returns. But it's basically equivalent to say we've achieved a greater frontier. We're at a point on a higher frontier. So for a given level of risk, we've attained higher returns. For a given level of return, we've attained lower risks. So as written, in fact, I'm sorry for the confusion here. As written, in fact, C is the only correct answer. E says make them less risk averse. Okay, does it make you less risk averse to diversify?
Yes.
Okay.
Yeah. By diversifying, you're less risk averse, and it doesn't necessarily make you less risk averse because you can go further along to the right or on the line, but it gives you the option.
So I think what you're confusing here is Harry, was it?
Yeah.
Harry, is the terminology here. But this is very important. So there's a division here, and when we talk about other types of optimization, between preferences and constraints. Okay, my risk aversion is a characteristic of my preferences. It stems from as we model it, it stems from my utility function, or you can look at this utility of income function. This other type of utility that we maximize the expectation of. Okay, so if I have a utility of income that's increasing at a decreasing rate, I'm risk averse. And my level of risk aversion is basically, I haven't given you a definition of the level of risk aversion, but it's basically determined by how curving this is. What is the curvature of my utility of income? In other words, compared to a particular point of income for certain, what's the relationship between how much I gain if I had a little bit more and how much I lost if I had a little bit less, right? So if the amount I gain from having a little bit more is approximately the same as the amount I lose for having a little bit less, I'm not very risk averse. But if this gets me very little, if this gain gets me very little gain, but this loss gives me a huge loss, I'm very risk averse. Getting back to the point, risk aversion is a characteristic of your preferences, and your preferences do not change, or at least they won't be assumed to change based on your opportunities or based on the investments you make in the classical model. So while it's true that diversification will allow you to achieve a better outcome in terms of getting the same for a given expected return, achieving less variation, achieving less risk, and thus achieving less utility, it's not that it affects your preferences. Okay, just like changes in prices don't affect my utility and changes in prices don't affect my utility function and don't affect my indifference curves. It just affects what utility level I can attain. Okay, let me move on if that's okay, or any further questions on this one. So E is not correct. Just suppose I'll move on with this one. And sorry for the bug in the choose two. In fact, there are only one correct answer as it's written. All right, let me move on to question 14. By the way, it's very helpful having you here. It makes it a lot less like I'm talking to myself, so it makes me feel less crazy. So I believe I said 11, 15, and 16. Is that correct?
Yeah.
Okay.
11, 15, 16.
Okay, question 15. Choose all that are correct and no more, and that's going to be probably the main format for MCQs, although I might have said, there might be somewhere I say choose only one. I can't recall. I could look that up. If there's choose only one here, there will be on the final. Okay, consider a one-shot game where firms A and B simultaneously choose, typo, but not in a substantial one. Consider a one-shot game where firms A and B simultaneously choose which price to charge. Okay, game theory. Given the nature of competition in their differentiated products, the figure below depicts their best response functions. Okay, again, there's another grammatical typo there. Okay, so just to refresh, you probably have this on your screen, but this is the figure below. Okay. And I'll draw it on the board. So we have two players in this game, and their strategies seems to be that they can choose any price. Okay, so this is a game we called it a game with continuous actions. So this is firm A's price, PA. Hope that's visible. Strategic choice for firm A, PA. This is firm B's price, or P sub B. Okay, we draw the reaction function. Okay, Allison, I'll try to get to your question after the chat because I want to move on with this. Okay, so we see firm A's best response function. That should be the blue one. Doesn't matter too much. And we see that it is upwards sloping. But let me make it a little bit more gradual so you can see that it's upward sloping, not vertical or backwards bending. So this is firm B's best response function. You could call this B, if you like, BR subscript B. Or you could say this is firm B's best response function, PB star, as a function of what firm A chooses. What does that mean? Actually, hold on. This is firm A's best response function. Let me say this again. Okay. Firm A's best response function. So this is best response, if you like, of firm A, or you could say this is what will firm A choose as a function of what firm B chooses. Okay. So for every point on the vertical axis, firm B's choice, this tells me what firm A would do to maximize her own profit. Given that firm B has chosen this amount, I don't know, 5, firm A will choose this amount here. I don't know, this looks like maybe 6 or 7, I'm not sure. Okay, so it projects from here to here. Best response functions. This comes out of an optimization problem. I haven't shown you the optimization problem. I'm not going to ask you to derive those optimization problems, but I want you to understand. And I give you an example of the derivation of the optimization, if you like, in the case with the shepherds in the text. Okay, this is, now I will draw firm B's best response function in this example. And it seems to start at 5 and also goes in this direction. Okay, so this is best response of firm B. You could think about it as price of firm B star for best response as a function of the price of firm A. So what this says, you see it's also upwards sloping. So what this says is for any price of firm A, this is the price that firm B would choose if it were optimizing, if it were maximizing its profits. So if time allows. So we say, all right, so suppose firm A had chosen, I don't know, 5. It looks like firm B would choose, looks like 6 or 7 or 8. Okay. Okay. Let me see if there's any questions on this so far. Any questions on this so far? Does it, so I could see, what if firm A had chosen price 0, firm B's price is,
There at the point.
sorry, it says 5, but
5,
it's maybe not
okay,
large enough. Yeah,
sorry.
right. And if firm B had chosen a price 0, it looks like firm A is going to choose a price 5. These look to be symmetric to me. Okay, now let's get to the question. Which of the statements are true? Which of the statements are true? Sorry, someone sent a message that was kind of funny. The Nash equilibrium will certainly lead to an outcome which maximizes the sum of the firm's profits. Okay, so I'm going to say this is wrong. Okay, A is not correct. How do I know it's not correct? Well, I mean, I really don't. I haven't given you the firm's profit function, so I don't have a basis to say whether or not it's correct in this particular case or not. So I can't, it's false that it will certainly lead to an outcome which maximizes the sum of the firm's profits. Furthermore, we know in general, and we've seen cases, that Nash equilibrium are not always Pareto optimal. They don't necessarily always yield the best outcome. And in this case, we could imagine that, it's quite possible that competition between firms makes them both worse off. There's some sort of price war between firms. Maybe both firms would make greater profit if they both somehow conspired to charge a higher price. Okay, so A is false. B, if firm A charged a 0 price, would firm B also want to charge a 0 price? Well, this is this axis represents the price charged by firm A. We see if firm A chooses 0, firm B wants to choose a price of 5. That's the best response. So B is false. C, there is a Nash equilibrium where each firm chooses a price of about 10. Okay, what is a Nash equilibrium? It's a hypothetical question, or you could jump in if anyone wants to answer. Harry?
No, I was
not sure.
Hand up to say don't.
All right, you're staying out of this.
I'm staying out of this.
Okay. A Nash equilibrium is a pairing of strategies, one strategy for each player. Sorry, if there could be more than 2 players, but with 2 players, one strategy for each player, such that each player's strategy best responds to the other player's strategy. Okay, it's a pairing of strategies. Now, in these diagrams, what would that look like? It would look like A's best response to B's strategy. A is playing a strategy that best responds to B's strategy, and B is playing a strategy that best responds to A's strategy. So it's going to be a point where their best response functions meet. So at this level, which looks to be about 10, okay, it doesn't look on this graph, but in the diagram given, it looks to be about 10. If A chooses a price of 10, then B's best response is to choose 10. If B chooses a price of 10, or B's strategy is choose a price of 10, then A's best response is choose a price of 10. So if A's strategy is choose a price of 10 and B's strategy is choose a price of 10, they're both best responding. So C seems to be a correct answer. D, there's a Nash equilibrium where firm A charges 10 and firm B charges substantially less than 10. Well, if firm A were to charge 10, we see firm B's best response is to charge 10, not to charge any amount substantially less than 10. Okay, it's not that it bumps up here somewhere else. Okay, so D incorrect. And E, the greater the price that firm B charges, the greater the price that, the greater the price that firm, what it said, the question says, the greater the price that firm B charges, the lower the price that firm A wants to charge, or the lower the price that firm A's best response is, right? And that, in fact, is the opposite of what we just said. We said, look at A's best response. As B increases, A's best response, the price A wants to charge, or the price that maximizes A's profit, in fact, increases. Okay, so in fact, we call this strategic complements. All right, that's the term we use here. In other cases, we saw strategic substitutes where these were both downward sloping. That was the case of the shepherds. Here we call this strategic complements. In other words, just like if you remember with two goods, we had goods were complements in price. If the price of one good increases, then the quantity demanded of the other good increased. Here, if one player chooses a higher value, the other player will prefer to choose a higher value. So these are complements in that sense. Okay, so C and E. Move on if there's no other questions. Okay, marking mechanism. Someone asked a question about marking mechanism. I'm just going to give you the brief on that. Okay, I'll give you do it by way of example. Okay, so this question had 2 correct answers. Okay, so the number of correct answers is 2. This question had 3 incorrect answers. The number of incorrect answers is 3. Being a bit slow here. All right, so if I got both of the correct answers, I would get 2 out of 2 correct answers. And if I got none of the incorrect answers, I get minus 0 out of 3 incorrect answers. So I get 100% of the mark credit, and this is worth 4 marks. So I say times 4. So I would get, 1 times 4 would give me 4. Okay, I didn't leave enough room here. Suppose I had gotten 1 of the 2 correct answers, and I had also gotten 1 of the incorrect answers here. Okay. Well, I got half of the correct answers, but I got a third of the incorrect answers. Okay, look at this fraction. It's 3/6 minus 2/6. So that's going to equal, I will get 1/6 of the total marks. 1/6 of 4 is 4/6, or I'll get 2/3 of a mark. Okay. What if I got 1 correct answer and 2 incorrect answers? Well, this adds up to a negative number, a negative 1/6, I believe. But I'm not giving negative net marks for any question. So that would just add up to 0. Okay. And I don't know, I could give you another example. Suppose I got two of the 2 correct answers and 1 of the incorrect answers. I would get 1 minus 1/3 of the credit. So I'd get 2/3 of 4, or 1 1/3 marks. Okay, I hope that illustrates it by example. Okay, question 16. Okay, another game theory question. Choose all that are correct and no more. Consider the game below. Okay, just so we're all on the same page, it's this right here. It's a 3x2 game. It's a game with discrete rather than continuous actions. You can only choose a finite number of actions, at least, or strategies, at least pure strategies. It's a matrix game. This payoffs are displayed in a matrix. Okay, and then this is also getting at the issue of competition between firms, but that's not something we've covered directly. So just to give you some idea of what I was thinking about when I came up with this question. This all falls under the category of industrial organization. Sorry, I'm going off on a tangent. I won't continue. All right, so let's draw the game. We have the the row player. You choose which row. So we have row player can choose enter fully. I'll just abbreviate it EF. Enter partially, EP, or don't enter. I'll abbreviate that DE. Column player can choose among these 2 possibilities, enter or don't enter. Okay, just to avoid confusion later, why don't I make the column player's strategies abbreviated in lowercase? Okay, so players, row and column. Actions or pure strategies, enter fully, enter partially, don't enter for row, enter or don't enter for column. Payoffs, I'm going to draw them in. We always denote the row player's payoff first in these matrix diagrams. So for instance, if row plays enter fully and column plays enter, row gets a payoff of 2, column gets a payoff of -2. This says 2, 0, 6, 0. I'm just filling in the payoffs here. 0, 0, 5, 3, 4, 1. Okay. I'm not going to cover equivalent variation. Okay, wait. I'm going to go back to one question, and I'll try to cover the others later because it pertained to the last problem I just asked. Why is E correct for question 15? Just going back a second. Why is E correct? The greater the price that firm B charges, the lower the price that firm A wants to charge. Remembering back to this. Okay, you say if the firms are perfect complements. I think you meant to say if the firms are under perfect competition. Products can be perfect complements. The firm's products could be perfect complements, but the firms themselves are not perfect complements. So shouldn't B raising its price lead to A also raising its price? Oh, I'm sorry. Did I say E was correct?
Yeah, you said that C and E were correct.
Sorry, my brain's a bit dead. I meant that E was incorrect. I'm so sorry. It says in the answer key that E is not correct also. Sorry. E stated the greater the price that firm B charges, the lower the price that firm A wants to charge. In fact, no, it's not the case. The greater the price that firm B charges, the greater the price that firm A wants to charge. Sorry, I think I needed more coffee today. Okay, so no, E was incorrect. I'm sorry for that confusion there, but it's consistent with what I said in the solution. So yeah, thanks for catching me on that. All right, back to this problem here. Maybe I'll try to edit the video if I can. All right, so what is this question asking? Which of the following are true? A, enter fully is a strictly dominated strategy for the row player. Okay, so they're asking me about strictly dominated strategies. We're not saying anything about iteration. We're just saying, is it strictly dominated? Correct, Melea. Strategic. These are strategic complement. In the previous example, it was strategic complements. Okay, sorry. This is a bit two tracks. It's not ideal. Well, so I'll try to focus on what we're dealing with now. I'll try to answer the comments later on rather than in real time in some cases. Okay. Strict domination. What does it mean for a strategy to be strictly dominated? A strategy is strictly dominated if there is another strategy such that that other strategy is better no matter what the other player does. So that other strategy is always better. So A is strictly dominated by B if B is always better than A. Okay, B strictly dominates A if B is always better than A, no matter what the other player does. Okay, is enter fully strictly dominated for the row player? Let's take a look. If the row player plays enter fully, the row player will get a payoff of 2 if the column player enters, or 2 if the column player doesn't enter. So no matter what the column player does, the row player's payoff is going to be 2 if she enters fully. Okay. Is it strictly dominated by another strategy? Is there any other single strategy that always yields the row player a greater payoff?
Partially.
Enter partially, right. If the column player chooses enter partially yields a greater payoff, 4 is greater than 2. If the column player doesn't enter, it also yields a greater payoff. So to be strictly dominated by a single strategy, it has to be that strategy is always better. So enter fully is strictly dominated. So looking at my answers, B, C, D, and E, I'm going to say A is correct. Okay, for for row, or the row player, don't enter is the unique rationalizable strategy, parentheses, survivor of iterated strict dominance. Okay, just a sec to answer a question. It is in the flow here. Does strictly dominated pertain players A's own strategy? Option A is strictly dominated if option B taken by player A yields a greater payoff. Yes, if it yields a greater payoff, no matter what the other player or players do. Okay. Getting back to question B, or option B. For row don't enter, is it true that for row don't enter is the unique rationalizable strategy? In other words, is it the unique survivor of what we call iterated strict dominance? Well, the only way I could answer this question, if I can't rule it out quickly, is by computing what are the rationalizable strategies or strategy by doing this process of iterated strict dominance. So let's do that. Okay. Okay, so let me just do this process right here. Okay, how do I do the process of iterated strict dominance? I first say, is anything strictly dominated in this first stage? Or is anything strictly dominated in the full game? Okay, and we just agreed that something was. We said that enter partially, if you like, dominates enter fully. So I'm going to cross off enter fully for the row player. Okay, and the logic here is that the row player wouldn't, if there's no belief the row player could hold that would justify choosing enter fully, no belief about what column player would do, the row player is never going to choose enter fully. If he's rational, which we assume, column player also will know that the row player will not choose it because there's common knowledge of rationality. Column player knows that the row player is rational. So the column player knows row player will not enter fully. Okay, so now comes the iterated part. We can say, well, given that column player knows the row player will not enter fully, in this reduced part of the game, is any strategy for the column player dominated?
E, yeah.
Enter is dominated. Let's see, is that, let me just check if that's, I think you meant the other thing. You meant dominant.
Button.
You meant dominant strategy.
Yeah, it's a dominant strategy.
It's a dominant strategy, yeah. So don't enter for column is dominated. So
Yeah.
we cross it off. All right, how do I know that? I look at don't enter. I see, okay, given I've ruled out enter fully, if I'm column player, I get either 0, sorry, if I play don't enter, I get 0 if row plays enter partially, 1. If he plays don't enter, I get 0 rather than 3. In either case, I would be better off choosing enter. So I'm going to cross this out, and if I wanted to write it down, I would say enter, this time for the column player, is dominating don't enter. Okay, now we can finally, we're just left with 2 cells. And we can iterate once again. So given that the row player knows that the column player knows that row player is not going to play EF, therefore the column player will never play DE. Does the row player have a dominated strategy in this remaining game? And the answer is obviously yes. The row player, there's only one thing to compare. We don't have to say, is it always better? It is always better, but there's only one situation left. You're just making basically a simple choice with respect to this, and 5 is greater than 4. So enter partially in this iteration is now dominated by don't enter. In other words, don't enter is dominating enter partially. All right, getting back to the question. The question says, for row, don't enter is the unique rationalizable strategy. Well, what survived iterated strict dominance? I should also cross this out. So only don't enter survived iterated strict dominance. It's the unique rationalizable strategy for the row player. For the column player, enter is the only unique rationalizable strategy. Okay, so B is correct. Just one aside, Harry, you had spoken about in this reduced game, you said, I had asked you, is any strategy dominated? And you meant, is any strategy dominant? You said E was dominant because DE was dominated. In fact, if there's only 2 options, if one strategy is dominated, the other strategy is dominant. But if there's 3 options, one strategy can be dominated without another strategy being dominant.
Oh, okay.
Right? Because it can be better. The second strategy can be always better than the first, but there's also that third strategy.
Yeah.
Okay, just something to think about. Okay, so the other answers, C, is row don't enter, column don't enter a Nash equilibrium? Well, I already know that it's not, okay? One reason is that I know, and I stated this as a rule, I didn't prove it, but if there's only a unique pairing of strategies surviving iterated strict dominance, if there's only a unique pairing of rationalizable strategies, that strategy is the unique Nash equilibrium. So this other strategy can't be. But suppose I didn't know that or I didn't remember that rule. Well, I'll go back to the original matrix and I'll either solve for Nash equilibrium using my underlines, or I'll just look at this one particular strategy. So if I look at the strategy, or sorry, profile of strategies, pairing of strategies. So if I say row don't enter, column don't enter. So if I look at this combination here, I can say, is this a Nash equilibrium? Well, if by playing don't enter, both were optimally responding to the other not entering, it would be a Nash equilibrium strategy, or sorry, a Nash equilibrium profile of strategies. However, if either had an incentive to unilaterally deviate, it would not be a Nash equilibrium profile of strategies. Okay, so suppose column had played don't enter and row is playing don't enter. Could row do any better by changing their choice? If column's playing don't enter, does row's best response to play don't enter?
Sorry, I didn't hear.
No, that's okay. So the question is both playing don't enter a Nash equilibrium strategy profile? So if, for instance, so I can know that, I can check that to see are both best responding, or would any want to deviate from that given what the other is doing? So if columns playing don't enter and rows playing don't enter, would row have rather played something else?
Row would have rather played EP.
Yeah, or EF, either of them. So it would rather have deviated. So that is not a Nash equilibrium strategy profile. So C is false. D, for row enter partially is the unique rationalizable strategy. Well, we've already decided that no, that's not true. This is don't enter is the unique rationalizable strategy. E, don't enter is a dominant strategy for the row player. Is don't enter a dominant strategy for the row player? Okay, so this is a little bit more challenging because we know it is the unique survivor of iterated strict dominance, but is it in the game as a whole the dominant strategy or a dominant strategy? For it to be a dominant strategy, it must be that it's no matter what the other player does, it always yields a higher payoff. Okay, well, let's look at that. Okay, so is this a dominant strategy? I said for the row player is don't enter a dominant strategy. Well, let's see. If the column player chooses enter, then don't enter is in fact the best response. However, if the column player had chosen don't enter, then enter partially would have been the best response. So don't enter was not a dominant strategy. Even though it was the only rationalizable strategy, it's not a dominant strategy, right? Enter fully was dominated, but don't enter was not dominant. All right, I'm going to move. It might be a good idea at this point to take just a 2-3 minute break, and then we'll move on to the longer answer type questions. But does anyone have any questions on this one? I'll follow up on. Okay, let's take a 3-minute break, and then we'll continue. I'll just leave this going, and do what you feel is best. Just get a glass of water or something. Coffee, don't have time for that. Just gonna get a glass of water. Do you want one?
Yeah, actually, please.
You can hang out or.
Yeah, I'll sit here actually.
All right.
So
Okay.
thank you.
All right.
Well, go on, boys. We've got the first social of the year coming up on Monday, the something. Can't remember. I think it might be the 13th. What's the questions here? Yeah, no, it seems good. Seems good. Can't believe that none of you fucking joined me here. So rude.
All right, just checking some of the questions. Strict dominance versus weak dominance. So we haven't covered weak dominance. Well, I think I maybe I mentioned it in one of the questions. So let me make it clear what weak dominance would be, just as a way of explaining what strict dominance is, to help you better understand it. Okay, I'm just going to say I'm going to cover strict dominant. I'm going to cover strict and weak dominance right now, but not iterated. Just one iteration or one go. Okay, so suppose we have a row and column player, and rows payoffs are, let's see, 1 and 3. Whatever columns payoffs are, I'm not going to worry about right now. If he plays the up strategy, suppose if he plays the middle strategy, the payoffs are 1 and 0. Okay. So the question is, does up dominate middle? So the answer is up does not strictly dominate middle, but it does weakly dominate middle. Okay? Because it's not the case, so let's call this left and right. It's not the case that whatever the column player does, the row player is better off playing up. Right? Because if the column player plays left, the row player is equally well off playing up or middle. Okay? But this would be an additional concept, the weak dominance idea. You might think it's reasonable to think that the row player will never want to play middle because up is always at least as good. That's the concept of weak dominance, but it's not a concept we've covered. And you might think it should be the concept we use instead of strict dominance, but there's some technical reasons why we don't. So that's what the weak dominance is. Okay, so I hope that helps it, and because iterated weak dominance can be a mess. That's why. I'm not going to get into the details of it though. Can there be multiple dominant strategies if the payoff of two options are the same? I don't think they would be called dominant strategies. I think it has to be strictly better to be called a dominant strategy, or to be I think you might then call it two weakly dominant strategies. All right, let me move on. Just after I pour myself a coffee here. It's the worst coffee. making apparatus, but I ran out of filters. So.
Not ideal.
No, yeah. It's better than still's got the caffeine. So do you think Bob the Builder he's a student? I mean, right? Why else would he be on the?
Oh, I assume so.
Yeah.
Oh, or he's just a tuber enthusiast.
Yeah.
I
Or
think
and a
I think
PewDiePie
we're all
enthusiast.
tuber enthusiasts after a couple of their videos.
I didn't think that you would check those videos
Oh,
too.
we
but-
did.
Okay,
No,
good.
We have.
So
love
you are you and the donkeys. You guys could form a fan club. I
them. Oh,
think.
of course.
Okay. Let me move on to what is the
We're highly anticipating the next one. First one of 2020 is going to be big.
I was gonna bring you to the lecture theater, but it's all the way up on the hill, so I just wanted to shock and awe. I was gonna cover one of the longer answer questions, so let me dig into that. Okay, I believe it was the insurance problem I was hoping to cover. So let me clean the board a bit. All right, so just so we are all on the same page here, this was a problem from one of the problem sets, but I also recommend it as a longer answer problem. Suppose there's a 50-50 chance that a risk-averse individual with a current wealth of £20,000 will contract a debilitating disease and suffer a loss of £10,000. Okay. You can tell this comes from a problem from the U.S. textbook because they don't have NHS and people might be uninsured, but all right, I don't need to give into the motivation of it. It's just take it as a problem and try to solve it. Okay, a 50-50 chance of a loss of 10,000. Calculate the cost of actuarially fair insurance in this situation. Okay, so it's asking me two things. Always try to read things carefully and say, oh, he says you got to do this and you got to do that. So don't forget the first and jump to the second. All right, what is the cost of actuarially fair insurance? What is actuarially fair insurance? It's insurance that costs the same amount as the expected monetary value of the payout. So, if I'm on holiday and I'm buying insurance for my car against scrapes and scratches, and there's a 300-pound deductible, and it says you can waive the 300 pounds maximum charge, but you can waive the deductible if you buy the insurance. If my probability of scratching the car more than 300 pounds, or let's say exactly 300 pounds, is 50%, then actuarially fair insurance should cost 150 pounds, right? Because half the time I'll be getting a reimbursement of 300. So in this case, it says calculate the cost of actuarially fair insurance. Presumably I meant full insurance, fully insuring you against the loss. So half the time the person loses 10,000. So the expected value of the loss, expected value of L, I'm calling this E of L, equals 1/2 times 10,000 pounds, or 5,000 pounds. So half the time, the insurance provider will have to pay them back 10,000, or will have to pay them 10,000 to compensate them for their illness or for their loss due to the illness. So the expected cost, the cost on average to the provider, is 5,000. So if it's actuarially fair, it'll cost 5,000 to purchase this insurance. Okay. Now we can use this towards answering the next part of the question. So if she doesn't buy the insurance, then no insurance, I'm going to write this down, no insurance, then she ends up with having a net income of 20,000 with 50% probability and 10,000 with the remaining 50% probability. If she buys the insurance, well, it depends how much insurance costs, but we're saying, what about actuarially fair insurance? If she buys the insurance, then it will cost her, if it's actuarially fair, it costs her 5,000. So she starts with 20. So half the time she starts with 20, she buys the insurance, so she loses 5. So that's 50,000 with probability 1/2. The other, and here she hasn't sustained a loss and she hasn't been reimbursed. The other half of the time, so this is the case with the loss, this is the case with none, no loss, right? So before the insurance, if she didn't have a loss, she keeps her 20,000. If she had the loss, she ends up with 20,000 minus 10 or 10,000. If she buys the insurance, it's full insurance, so she'll end up with the same amount each time. So if she sustains the loss, she started with 20, the insurance cost her 5, I'm abbreviating here. She's lost 10, but then she's reimbursed by the insurance, so obviously these terms cancel out, and she's left with 50,000. Okay? Okay, so it says use a utility of income graph to illustrate, to show that the individual prefers, if full insurance is available, the individual prefers to buy the full insurance. Okay, let's do that utility of income graph. I'm going to erase these computations here. I think you can keep it in your head. It's a pretty straightforward idea. Okay. Okay, so let's draw a utility of income graph. This is what I call von Neumann-Morgenstern utility, perhaps the most difficult conceptual concept in the module. I'm not sure. It's the utility of outcomes. Okay, so on this axis, we have income in thousands of pounds, or wealth, whatever. On this axis, we have this little utility, this utility of outcomes. And we say she's risk averse, and the standard way we model that is saying her utility increases, but at a decreasing rate. So she has this curve. Note it never comes completely flat. It's always still increasing a little bit. Okay, I want to sketch this out so that I have room for everything I want to draw. It's very easy to use up the room. Absolutely. Always looking for people to play with. 20,000 will be over here. The worst outcome, in a sense, 10,000 will be down here. I've stretched out the axis a bit just to make it, because you see the 0 here, the 10's here, the 20's here. So it's just to make this fit nicely. You don't even need the 0 to be there. It doesn't matter. Okay, so we can use in this diagram, we can sketch what her expected utility is. And remember, one maximizes one's expected utility, not necessarily one's expected wealth. We can maximize expected utility. The person is going to maximize the expected value of this. Basically the average value of this weighted by the probability of the different outcomes. Okay, if he or she, do you see that I put the blue pen? Oh, cheers, I got it. So if he or she, thank you. If he or she fails to buy the insurance, then half the time she will end up with 20,000, half the time she will end up with 10,000. What is the utility of 20,000? Well, luckily we have the utility of income diagram to tell us. Utility of 20,000, I just project over to here. Right, 20,000, what's the utility of it? This tells me. So this is utility of 20. What's the utility of 10? The utility of 10, start with 10, project up to here. This is the utility of 10. Obviously, it's less than the utility of 20. Okay. If she doesn't have insurance, half the time she ends up with this utility, half the time she ends up with this utility, because the probability of each is 1/2. So in fact, her utility will be halfway between here. Her expected utility will be halfway between here and here. Okay, so we could call this expected utility with no insurance. No insurance. So we could say expected utility of 1/2 probability. I'll just use this as an abbreviation of 20,000 and 1/2 probability of 10,000 will equal 1/2 times the utility of 20,000 plus 1/2 times the utility of 10,000. Okay. It turns out, and I gave you the algebraic and graphical argument in the handout, that this point here corresponds to a point on the arc between these 2 points. So suppose this is a straight line between these 2 points. And then suppose we go half the distance between here and here, okay? Or P of the distance where this is 1 minus P probability of this and P probability of this. Okay, which takes us to the point 15. And we project up to the axis here. This point here will correspond exactly to this point here. Okay, so this will help us with our visual understanding. So if I'm uninsured, my utility is half of this and half of this, or this amount right here, which in fact, I think in the diagram given, we labeled as utility A. This is called point A in the diagram given. What if I'm insured? We said if I'm uninsured, I get 20 half the time and 10 half the time. If I'm insured, I get 15 all the time. What is the utility of getting 15 for sure?
15 for sure is 100% if you have insurance.
Right. So it's the utility of 15. This is the utility of any outcome.
Yeah.
So it's just simply 100% of the utility of 15. Right. So I could write that expected utility of 1 times 15 equals utility of 15. So the utility, if you bought this fair insurance, go to 15, project up to here, and then project over to here. And this here is the utility of 15 for certain. Okay, so have we done what the question asked us to do? Have we fulfilled our contract? The individual will prefer fair insurance against this loss to accepting the gamble uninsured. Yeah, I think I have. If she accepts the gamble uninsured, she gets this utility or this expected utility, which is less than this utility. I could also give an intuitive argument for it. I know the individual is risk averse. I know the definition of risk aversion. That's better with an I guess. I know the definition of risk aversion, and I know that the definition of risk aversion is that someone who's risk averse will always, or one of the definitions, someone who's risk averse will always prefer a certain outcome to an uncertain outcome, or to an outcome with greater variability if the expected monetary value is the same. Right? If she's insured, the expected monetary value is 15, and there's no variance. If she's uninsured, the expected monetary value is also 15, right? So not the expected utility, expected monetary value, half of 10, half of 20, the average is 15, but there is variability. So I know that having this for certain is better than having some amount that equals this amount on average. Okay. What else did I say in the notes? Okay. Yeah, there's some discussion as to why this point, the point from projecting up from here to here, is the same as this point here, which I discussed in the notes to this question. Okay. I'm not going to reveal exactly, just answering some questions here. The variability of uncertainty chapter. I don't understand the question. Maybe you can clarify. I mean, explain the whole chapter, or Maybe if you could ask specific questions in the hypothesis, I'll still try to have time to answer it. Will there be a long answer question on consumer optimization? I'm not going to say exactly what's going to be on the exam, but look at the mock exam and look at what I've said before. How weighted the exam is on stuff on monopolies. Again, look at the mock exam. It should be fairly representative. Okay. Continuing, that was just part A, the easy part. Suppose two types of insurance were available: a fair policy covering the complete loss and a plug this in, and a fair policy covering half of any loss occurred. Okay, calculate the cost of the second policy and show the individual regards it as inferior to the first. So what does it mean to cover half of the loss incurred in this case? So if she loses 10,000, she's bought insurance, how much will it reimburse her?
It'll reimburse her the full amount, 20,000.
No, well,
Oh,
that would be full insurance, right?
sorry.
So she's buying insurance
For half. you mean?
that covers only half of the loss incurred.
Yeah, the 5.
So if she bought such insurance, then she'd pay the cost of the insurance, right? Taking her whatever it cost, then she'd lose 10, and then how much would she be reimbursed? She'd only get halfway back.
Yeah.
Okay, so let's see what that looks like. Okay, so what's the cost of this policy? What if it's actuarially fair? Its cost is the amount that you expected to be reimbursed. So the total L equals 10,000. So half of L is equals to 5,000. And now the expected value of half of L, half of this loss, 5K, it's the K, I'm just leaving out the K for brevity. Expected value of half of the loss is equal to the probability of the loss. So, half the time there's no loss, and half the time there's a loss, or half the time, so this is the probability of the loss, P, or 1/2. Half the time the loss is 10,000, so half the loss is 5,000. So this equals 2.5 thousand. Okay, 2.5 thousand. So that's the expected value of the loss. So that's the cost of actuarially fair insurance. Okay, so suppose she buys this actuarially fair insurance. What do her outcomes look like? Okay, so I could have kept up a table. Maybe it would have been helpful. So the no loss state, and then the loss state. So suppose she doesn't buy insurance at all. So no insurance. In the no loss state, she ends up with 20,000. In the loss state, 10. If she bought full actuarially fair insurance, then in the no loss state, she paid 5,000 for this insurance. So she ends up with 20 minus 5 or 15, as in the loss state, because she pays 5,000, loses 10, reimburse the 10. And in the partial or half insurance, partial actuarially fair insurance, she starts out with 20. She pays 2,500 for the insurance. If there's no loss, that's the end, 17.5. If there is a loss, she's paid 2,500 for the insurance. She loses 10,000, so she's down to 7.5, but she's reimbursed half of the loss, so she's reimbursed 5, so she ends up with 12.5. 12 and a half. So we see it's partial insurance because she's still facing some risk. Okay, so the question asks me to show that the second policy, the partial insurance is inferior to full insurance. Okay. So if she gets the partial insurance, then half of the time she has this income leading to the utility up here. It's given in this diagram here a bit more neatly. Obviously, it becomes messy when I try to draw too many things on the screen. But here we see the utility of 17.5. And half the time she ends up at 12.5, which leads to a utility. It shouldn't necessarily overlap that line, but it's going to depend on the curvature. She's going to lead sort of utility. Let me maybe put it over here just to make it more consistent. She's going to end up with a utility of 12.5. The utility of 12.5 thousand pounds. Okay, so half the time with this partial insurance, she ends up here. Half the time she ends up, what did I say? Where did I put it? Here. So her utility with the partial insurance should be halfway between these 2 points, which you can see, remember, the same rule should apply. Draw a line between these 2 points and then project up from the expected value, from the intermediate between these 2 points. So go halfway between the 2 points, project up to this line. It's very hard to see in this diagram, but it's much cleaner in the one that I used a computer to create. And you see that her utility falls below the utility she got with full insurance, this point being below this point, but above the utility she gets with no insurance. Okay. Okay, but there's the third part, and that's the hardest part, perhaps, in this case. Let me just see if there's any questions on this material. I don't want to cover general questions right now because it's going to distract from answering this question, but I'll try to have some time to go back to those general questions. Okay. So, part C. This would be like the most difficult material. There's a little bit of maths in it. You know, hopefully most people will get part A and B, and then maybe some people, you know, will get all of part C. I don't know. Okay. Suppose the person's realized utility function, this U that we've been talking about. Now I'm giving it an actual functional form. I say U is equal to V to the 1/3. Okay, obviously what V here represented was income. Right? And there's only one variable here to choose from, so that's what I meant by it. We haven't erased the partial insurance because we're not talking about that anymore. So I can clean this up a tiny bit without wasting all the time. Okay, what is the maximum amount they'd be willing to pay for full insurance? All right, let's try to figure out what that looks like graphically, and then we can figure out how to compute it. Okay, so if they bought the full insurance, it might be best to redraw this. $20, 10 was somewhere over here. 15, I think, is an important number here. I'll put this back up in a moment. Okay, just give me some more room. All right, so we have a utility of income increasing something like this. Never fully flat, though. It's just getting more and more towards flat. Okay. Okay, if they bought the full and fair insurance, they get 15 for certain, which left them with this utility here. Okay, but this is if it was actuarially fair. Okay, but the question is saying, okay, what is the most they'd be willing to pay for full insurance? We're not assuming it's actually, I mean, we're not saying it's actuarially fair. We're saying what is the most that an insurer, let's say if they were the only insurer providing this insurance, would be able to charge. In other words, what amount of insurance would they buy, or sorry, what would be the cost of insurance such that the person would say, all right, this is the most I'm willing to pay. I'm willing to buy the insurance, but I'm just indifferent at this point. So we have to remember, we have to say, well, what would that be? That would be insurance that would make them just as well off as they were when facing the loss. Right? This is their only choice is buy the insurance in this conceit or don't buy the insurance and end up with the utility of 10 half the time and the utility of 20 half the time, which as we discussed would put me at the point halfway between here and here, which is also the point you project up to. So this would be the expected utility when they're facing the loss. Okay, so the question is, what is the certain income? So if they buy full insurance, they start from 20,000, they pay the cost of the insurance, and that's what they get for certain. So the question is, what is the certain income that gives me the same utility, which is this amount, as facing this gamble, or this giving the same utility as 10,000 and 20,000, each with 50% probability. On this diagram, we can see it, right? Because this utility of income or utility of outcomes tells me the utility of everything of each thing for certain, having a thing for certain. So I say, what is the point that gives me this level of utility on this curve? Well, it's the point right there. The point right here, we can project down to there. Okay. Okay. I believe it's yeah. Okay. So the question is, what is this point here? So the question is, what is the income that gives me the utility equal to the utility I get when I get half the utility of 10,000 and half the utility of 20,000? Okay, so now we have to compute that. Okay, so I said again that the utility function is equal to income. I called it V here. I don't remember why, but that's not important, to the 1/3. So first question is, if this is my utility function, what is the expected utility of having 20,000 with probability 1/2 and 10,000 with probability, this is 10,000, not 10, but I'm just being abbreviation here, 20K with probability 1/2. So I know how to evaluate this. It's 1/2 times the utility of 20,000, which is, all right, let's write that down, utility of 20K plus 1/2 times the utility of 10,000. Okay. Now I know what this little guy is. It's 20,000 to the 1/3 power. So I say, what is 1/2 20,000 to the 1/3 power plus 1/2? Again, we know what this is, 10,000 to the 1/3 power. And this, I can pull the 1/2 outside. That's not so important. If I do this on a calculator, I take this to the 1/3 power, take this to 1/3 power, take half of those, I get something pretty close to 24.35. So this means approximately. Okay. So this tells me what this utility level is. Now I need to know what income generates this utility level. Well, this is, to be fancy, you would say invert the function. So in other words, I need to know, the 24.35 isn't exact, but just for the sake, it's close enough for now. Okay. So because there's a rounding error here. Okay, so I have to say, what is the income such that the utility of having income Y for sure will equal or approximately equal 24.3 5. Now I know what utility of y is in general. It's y to the 1/3 power. So I'm saying y to the 1/3 approximately equals 24.35. And I can, this is my rules of exponents, I can cube both sides and I just get y approximately equals 24.35 cubed. Which is approximately equal, or approximately equal to something around 14,400, and it's 37 or 27. I can't remember. It depends on the rounding error. So, does this make sense? Let's check our. Does this make sense? Let's check our work, or check whether it's a reasonable answer. Okay, they're just as well off if they have 14,437 pounds for sure. That would be somewhere over here, right? Okay, somewhere in between 10 and 15 at least. So this should, because I didn't draw the curvature to scale, I just guessed. So this point here is 14.437 thousand pounds approximately. Right, so then you can say, all right, so how much would they be willing to pay? They'd be willing to pay the amount that leaves them with this income for sure. So they'd be willing to pay 20,000 minus approximately 14,437, which is, I don't know, what did this work out to be? 6,000 or something like that? Something around
5,500.
yeah, something approximately that. Okay. So that took a long time. Okay, so
Yeah, because that's quite a big problem. So on the exam tomorrow, that's going to be worth like 5 marks or so.
5 marks.
5 marks, more than that, less than.
No, did you look at you should look at the mock exam. The longer answered questions are worth a lot more.
Yeah, they're worth, but this is part C of a longer answer question. So this will be worth a proportion of those 20 marks, what it's worth.
Oh, I see what you're saying. Yeah, in this case, I mean, I guess in this case, this whole question might be a little bit longer than I would expect for a 20 marks. Yeah, this is worth a little bit more than 20, would be worth a little bit more than 20 marks. Okay, where did u equals v to the 1/3 come from? Yeah, that was in the question. I said assume utility, I'm just asking that question. Assume the utility assume the utility of outcomes or utility of income was that income to the 1/3 power. All right, so I guess I'm sort of out of the allotted time. I'm just trying to think how I shall address this. How the remaining questions. I mean, some of the remaining questions I can address by writing them down. I said if I had time, which I obviously didn't, I would cover the question on the subsidies, which is basically the reverse, the lump sum subsidy. Subsidizing housing or subsidizing one commodity versus a lump sum subsidy was basically the reverse problem of taxing one commodity versus a lump sum tax. I said I would cover that. I have a PowerPoint that goes well with that. If I have time, I'll post some sort of talk along, but I've also shared the PowerPoint. Let me just see if I can address any of these other questions quickly. Others I'll address offline, as they say. All right, I'm going reverse order. How does price discrimination eliminate surpluses? Eliminates surpluses. I think you're talking about perfect price discrimination. And here we see perfect price discrimination. So we have a monopoly or whatever facing a demand curve. This being price, this being quantity, demanded, supplied. This is the monopoly. Then we'll have. Let's suppose there's a constant marginal. Suppose there's a constant marginal cost. Under perfect competition, we'd see price equals marginal cost, which would be efficient, and we'd see all of this triangle of consumer surplus. Under monopoly, there'll be a marginal revenue curve the monopoly cares about, and the monopoly will choose a quantity implying a price such that this is marginal revenue, such that this is the demand curve, such that the marginal revenue equals the marginal cost, yielding a smaller smaller consumer surplus, perfect price discriminate, but a greater monopoly, but a greater profit, because obviously under perfect competition, there's no profit or no producer surplus anyways. Price discrimination is saying, or perfect price discrimination, yeah, which is a theoretical ideal. The monopoly charges each person exactly the most they'd be willing to pay for each unit. And in doing so, they end up, the last unit they sell to the last person, or the last unit the last person values, they sell to that person at marginal cost. So under perfect price discrimination, we're back with this quantity, but every consumer is paying the most they'd be willing to pay and thus getting no surplus. And the monopoly is getting it all in terms of profit. So that's just a quick answer to that question. It's not a complete answer. You'll have to go to the handout, I think, for that and other things. Some other ones I can do quickly. Some diagrams you need to know, understand. If I have time, I'll post that. I mean, it should be in the web book. The price of options. Question 17 of the mock exam. Is that the price of options? Question 17? No, that's 17 was, 17 don't bother with. I've stated that we haven't covered in infinitely indefinitely repeated games. We just didn't have time to cover that. So that's been axed from exams. The price of options, look in I think the text has a section on it, read up on that, look a little bit at the handout, look at Wikipedia, have a general sense of that. Okay, so I think the Elias paradox, that's behavioral economics. We didn't have a chance to get to that. I'll be happy to discuss it in my office hours if someone wants to come by, but it's not going to be on the exam. And yet, the lump sum transfer, I've put up the PowerPoint slides. If I have time, please ask me questions on those. If I have time, I'll also put up some sort of supplement to that. So I think that should probably wrap it up. Oh, sorry, someone can only see half the whiteboard. It may be too late now, but I mean, I've gone over it in better, it goes over in better way in some of the other material. All right, I think the best thing to MSNE, that's, what's MSNE? Mixed strategy. No, you don't have to calculate it. You have to know what it is, but you don't have to actually do those calculations. All right, so I think it would be best at this point to end the video. Yes, I mean, of course, half insurance, because we went over it in a practice problem, so of course it's relevant. So I should end the video, and then I can respond to other questions. I'll keep this chat open a little bit, and then we'll move it over to the forum or asking questions via hypothesis, which again takes about 30 seconds to sign up for, and it's worked pretty well, I think. All right, and thanks Harry for being present. It was very helpful.
Thank you very much.
Good luck to everyone on the exam tomorrow.